So I think this is, what, the third conference I followed Keith on, so I'm seeing a trend. But I think it's always great to have Keith start because I think he sets the tone for, ooh, getting some bad coverage here. I guess he sets the tone for slightly smaller emerging studios and what it's like to raise capital from, as he said, you know, publishers or equity investors. This presentation is going to focus more on slightly more mature studios since this is really an M&A discussion and what's been going on in the game sector, really from a buyout perspective. So this is big publishers acquiring smaller publishers. Yeah, and so first a little bit about Agnitio. Maybe some of you guys have seen presentations before or not, but we were founded in 2003 in London. We're a fully authorized, regulated investment bank, again, based in London, but also have an office in Seattle, which is run by my partner, David Bloom, which many of you might have met over the years. We're focused exclusively on the game sector, predominantly mobile, but also online. We are principally an advisor, so we basically assist studios on selling themselves to larger publishers, but also in some cases we will assist them on sort of growth equity rounds. And when I say growth equity rounds, I'm talking about raising equity investment to the tune of sort of $5 to $10 million and beyond. Some of our recent deals, feel free to go to the website. You can, see some case studies as well. But, very recently, we literally last month sold eRepublic Labs, which is both an online mobile game publisher based in Ireland and Romania, to Stillfront Group. Just at the end of last year, we sold Babel Games, which is the leading Middle East mobile game publisher, to Stillfront as well. Here in the US, we sold Dragon Soul, which was a very successful RPG title developed by Pear Blue in Madison, Wisconsin, to GREE. And then literally around this time last year, we sold TickBits, which was a Finnish, profitable, long-standing business, but fairly small, to Animoca Brands. We've also made a couple of principal investments over the years. The one you guys are probably most familiar with is Hutch Games, based in London, which does a lot of pretty successful racing games, including Smash Cops and Hot Wheels, and also Game Influencer, which is an influencer business, which was founded by the former co-founder of Flare Games. So these were some of the trends, and I want to set the scene a little bit about, because I'm going to go into kind of the size of the market after this slide, and how phenomenal 2016 year was, a record-breaking year for M&A. But a lot of these trends are still valid. I pretty much haven't touched this from the beginning of this year. So the dominant players, I think we all know this, are continuing to crowd out the top grossing markets. I wouldn't even say 250. I'd say probably almost the top 300. And a lot of this is due to them just having these massive marketing budgets to continue to outspend everybody. I'd say probably the player that we're all familiar with that has done this is MZ here in the US. So again, if you're a smaller, mid-sized studio, it's really hard to profitably acquire users. As well as, and then in terms of the games themselves, you're starting to see a lot of AAA quality games, and that polish continue to get better as well. What's also interesting is the mobile games market has now become the largest part of the overall games industry, and will continue to grow and actually get bigger vis-a-vis the growth rates compared to PC, online, and console. And of course, when it comes to M&A, the Asian players, again, continue to dominate in terms of making the largest acquisitions of companies globally. They continue to have cash hoards and continue to be acquisitive. So this was the slide I was alluding to. So if you'll see 2016, it was really just an absolutely phenomenal year, $24.1 billion of announced transactions. And if you look at through the first half of this year, what's interesting is that actually, vis-a-vis compared to a lot of the historical results, we're on pace to have an above-average performance this year. So assuming the industry experiences a similar result, you'll end up at about 6.4, which compared to previous years is actually not a bad result. But what is actually particularly important is large deals actually still comprise the vast majority of that announced deal volume. So if you look even through the first half of this year, there's been basically 3 deals. United Luck Holding, which was a Chinese consortium which acquired Outfit 7 for $1 billion, W's acquisition of Double Down, and Netmarble's acquisition of Kabam's Vancouver studio. Those 3 deals, which totaled about $2.6 billion, comprised 80% of the announced deal volume first half of this year. And in 2016, which I call the year of the mega deal, really the billion-dollar-plus deals, you had 4, and those 4 deals comprised 84% of the $24.1 billion. Another interesting point, over the past 18 months, all acquirers of these large transactions have been Asian, with the exception of Activision, which acquired King. So, are we really going to have a repeat of 2016? A lot of people talk about the game industry maturing, specifically mobile. No, it's not happening anytime soon until there's another massively disruptive platform or another sort of interesting genre of games that just come out that nobody has figured out today. So 2016 was this perfect storm of really Chinese buyers asserting themselves, as we've seen, and even into 2017. And also you had console giants that weren't necessarily or didn't really understand mobile that finally had an opportunity to get into that space. But really, there's nothing left large to acquire anymore. Supercell is gone, King is gone. There's really not that many more billion-dollar-plus mobile game companies for either Asian companies to buy or console players to buy. So what is that going to mean? That's going to mean that a lot of these larger players, because they want to grab market share, will continue to look further and further downstream. So even if you look at this year, in the first half of this year, you've had a couple of deals. They weren't quite billion-dollar deals. It was only Outfit 7. These other 2 were less than $1 billion, close, but again, they're going to continue to be smaller and smaller deals. So given that scarcity value, you might actually see valuation multiples go up for acquiring these companies. And so I wanted to segment out what's being paid for these larger deals versus what's being paid for the smaller deals. So if you look at all of these deals here, these 8 companies that are roughly $1 billion or close to it, you're looking at data that's been largely fairly publicly available, since most of the companies acquiring these larger players were publicly listed. Basically, you're looking at average, sort of LTM sales multiple, that's latest 12 months of sales for those target companies. The average is you're basically getting about 3.2 times. And then the EBITDA multiples for the latest 12 months, you're basically averaging out at about 10.3. Bear in mind that because these are larger players, what they're getting paid that entire amount upfront in cash and without earnouts. So I didn't list out, obviously, all the small to mid-sized transactions because, frankly, we'd have several pages of it. So I've left the summary here. What's important to note is the distinction between the upfront payment or the no earnout versus with the earnout. So the smaller to mid-sized players, as you can see, over the last 18 months, the latest 12-month sales multiple was about 1.6 without an earnout. That's essentially the upfront cash or share consideration that they're receiving from these larger buyers. Now, if they were to hit those earnouts and achieve the performance metrics or financials that they've signed up for in those earnouts, then they could actually get up to 3.7 and near to what some of those larger players, or in fact more than what some of the larger players are getting. The EBITDA multiples were slightly less, came in at about 8.9. But do bear in mind, in fact, I'll mention it here. It's hard to track down a lot of the data for smaller to mid-sized players, since a lot of them are private companies. Sometimes the publishers or buyers buying them are also private companies, and they don't necessarily publish up-to-date financial information. So sometimes it's difficult to garner that. Obviously, the larger players are getting, significantly higher multiples, and again, that's what you pay when you're buying size and scale in the industry. I think what Keith mentioned, and a lot of that probably holds true here for M&A, is some of the qualities are going to be fairly similar. Everybody's looking for especially really an exceptional team, especially when you're buying companies. And the larger company you're buying, then the more world-class of a team you're looking for, and guys who've done it before, sold companies before, who've scaled large organizations. The track record really becomes essential. In some ways, to really distinguish yourselves or show that you're innovating, maybe you've managed to focus on a specific category or genre of games, really to diversify away from all the noise or Me Too or clones. Obviously now, particularly for the Asian players, profitability becomes really significant and almost a must-have. Not essential, but quite important. For a lot of the Asian players, geographic expansion, acquiring a beachhead operation in Western territories, whether Europe or North America, again, becomes more and more interesting as they want to expand out of their domestic or regional markets. And then acquiring specific skill sets is also fairly attractive. And then ultimately, everybody's really buying market share. We're in a very mature industry. So what does that consolidation wave mean for smaller to mid-size? Well, as I mentioned, the good news is that all the large players have pretty much been acquired. So the bigger publishers or buyers are going to continue to look downstream, continue to acquire smaller studios. So hopefully that'll actually push up valuation multiples. If you are a business that's profitable, growing, has certain of those skill sets or criteria or qualities I mentioned previously, then you should be able to be bought rather than sold. If you're not, or have certain maybe functional or attributes that are lacking, then it might be an interesting time to merge with other players that could potentially round out those functions that are missing. I do think, this is, again, I reiterate this every time, maintaining the status quo is probably unwise in a very mature and rapidly challenging market. Which brings us to the predictions. Again, I've virtually not changed these from 6 months ago. The Asian players will continue to consolidate. They are flush with cash and have very profitable businesses domestically and regionally. So they want to deploy that capital. And in fact, you have non-gaming Asian players. I'm sure we've all read about this, whether it's a Chinese poultry farm acquiring Digital Bridges and Splash Damage, whether it's a mining company acquiring Jagex, whether it's a chemicals company buying other players in the market. This will continue. Those players, again, despite the kind of regulatory constraints they have in China, will find ways to get capital out and continue to buy gaming assets because of the arbitrage, because of the significantly higher multiples they're going to receive if they acquire these assets from abroad, from, let's say, the US or Europe, where gaming assets aren't really valued as high for various reasons. I think it's important to note US players will continue to be absent, for, again, variety of reasons. They're just not taking, they don't have the same risk appetite as Asian players, and again, they don't also benefit from the same public market appreciation of gaming businesses. Small to mid-sized players will continue to get bought out. In fact, we speak to a lot of buyers globally, and a lot of them are, what would traditionally have been much more in their sweet spot. They're continuing to acquire smaller and smaller companies, again, because of the market share, land grab that I mentioned. Another interesting area, kind of on the periphery to games is the sort of whole UA marketing sector, which is highly fragmented, which I think most certainly needs to be consolidated. So we definitely think that there's going to be interesting transactions there. Again, 2017 will be an above average year, but certainly nowhere near 2016. And then finally, will consolidation actually end this year? Will there not be any mid-sized players left? And, 2018 is the year of VR. So that's it. We have time for... Okay, great. Yep, sure.
So in this entire picture, when you talked about the marketplace that is so complicated, where do indie studios fit in all this?
They don't really. I mean, it's pretty obvious. I think, as I mentioned, right, it's a very, very challenging market. I'm not trying in any way, shape, or form to be condescending, to be in any way try to not let an indie because I mean, I've supported many indie studios. I've been doing this for 13 years and seen them grown. Some of them are on to their third business. I just like to be brutally honest and say it's an incredibly difficult marketing environment. I personally, and I've even spoken to my partner about this at length, we might be advising different industry come next year, this time, because there's just not going to be any more M&A or consolidation in the industry. So, I mean, that's genuinely how I feel. I know.
Can I do a point? Why not? Sorry. The same cycle which you saw, what happened in the mobile industry, especially after the launch of iPhone. Do you see the same entire cycle repeating for VR?
Again, if I did, I wouldn't be standing here. I'd be, on a yacht and figuring out exactly which VR companies to invest in. But look, I mean, jury's out on VR. I think it has a lot of promise. I think there's a lot of studios doing a lot of interesting things. But until you have a demonstrable audience, significant installed bases, and VR companies that are making significant revenue, it's not a viable market. I mean, the only transaction we've seen is Google acquiring, Alchemy Labs in Austin, Texas, right? And those guys were like $4 million of revenue a year? I mean, how large is the VR market in terms of revenue for studios out there, total? A couple $100 million? I don't know. Until you have an industry that's in billions, is it going to be significant for people to make and place decent bets, acquire and say, okay, you know what, this is real. We're going to, spend $20 million internally figuring out VR and find the best talent, find a studio head, and really try to make something of it. Or we're going to go and acquire these 4 or 5 studios across the world. But we're not there yet. I'm not saying we won't get there. Maybe we get there in 2 years or 3 years. Your guess is better than mine.